Good morning, doctors, and welcome to this morning or this afternoon's webinar, depending on where you are in the country. I'm Justin Ditkofsky. I'm the Vice President of Healthcare Leasing at Cirrus Consulting Group, and we're also joined by Andrea Chan, a partner at MNP.
Hi, everyone. Thanks for joining us.
And I wanted to thank all of you for taking some time out of your day to join Andrea and I for today's webinar. We have quite a bit that we're going to cover off over the next hour or so. The first, call it, half of the webinar will be focusing on the real estate part of your practice, particularly for those of you who are lessees or tenants or essentially rent or lease space for your practice. And the second half of the webinar, Andrea will take over, and she'll be focusing really more on, financial and tax planning and how to just improve all overall efficiencies in your practice. So to start off, just to give everyone a little background on Cirrus Consulting Group, we've been in business for 23 going on 24 years now. We are a healthcare specialized tenant representation company. So, we essentially specialize in representing doctors in commercial real estate matters, but, primarily focusing on the negotiation of office lease agreements. So, we do work with doctors who are starting practices and need help with the initial lease negotiations after they've found a location that they're interested in. But we also work with, I would say probably more so, established practice owners who rent their space and have a lease agreement either expiring or coming up for renewal in the next few years. And we can actually renegotiate their rental rates as well as their terms during the renewal of their office lease agreement. Our corporate office is actually based in Toronto, Midtown Toronto for anyone who's local. We're actually at Yonge and Eglinton. But we do have operations all throughout Canada and the U.S. We're probably about 35% within Canada and 65% south of the border. And on an annual basis, we will represent a little over 1,000 doctors in the negotiations of their office lease agreement. So we are highly specialized. And the way our firm is structured, we're actually quite unique. We're not a brokerage firm. We're really more of a law firm / consulting firm. So we have an in-house legal team of real estate attorneys. We have a dedicated leasing team who are able to do research on rental rates, comparables, and essentially look at all of the relevant local real estate information. And we have an in-house consulting division, all of whom have a background in finance and economics and really work in parallel with our legal and leasing team to properly advise and support our clients. So just an interesting fact that I think, unfortunately most people are unaware of, and part of what we will also discuss this morning, but the lease agreement itself in particular, some of the terms and conditions do actually have broader implications on your ability to eventually transition out of dentistry, as well as your ability to eventually sell your practice. And unfortunately, in many cases, landlords will unreasonably involve themselves in that process, generally for self-motivated reasons. So we will spend a few minutes discussing at a high level how that occurs and why it occurs, and essentially how to structure your lease agreement to entirely prevent or circumvent that type of scenario. So the purpose of today's webinar is really, I guess at least the first half of the webinar, is really, call it three or fourfold. Our focus is obviously we will discuss the assignment clause in your lease agreement, which is particularly relevant for all of you who are considering retiring and selling your practice in the next, call it 5 to 10 years or sooner. Also relevant for any of you who are considering acquiring practices or additional practices. And we will talk about specifically how the assignment clause is generally structured very favorably for building owners and landlords, and generally quite ambiguously, and how that can expose you and your practice to liability. We're also going to talk about how to limit or remove various liabilities in your lease agreement, in particular, a personal guarantee. Unfortunately, as tenants, many of you would have provided personal guarantees on your lease agreement. Essentially, what a personal guarantee implies is that if there is a dispute between you and your building owner, they have the ability to pursue an action or a lawsuit against you personally, but they also would have the ability to pursue actions against the assets of your family and estate collectively. So obviously from a liability standpoint, not ideal, and we will spend some time discussing how to either remove or limit the personal guarantees in your lease agreement. We'll also talk about how to structure a lease agreement to really enhance your ability to sell the practice, as well as potentially increase the overall value of your business. And we'll talk about, again, how to make or structure the lease agreement to be particularly appealing to a prospective buyer, for those of you thinking of transitioning or selling your practice shortly. So to start off, just kind of a high level of what your lease agreement should be doing for you. First of all, your lease agreement should provide you with the ability to eventually sell your practice. The way many lease agreements are structured, in order for you to facilitate the sale or acquisition of your practice, you will need to go through a formal process with your building owner in terms of assigning or transferring the lease agreement to the new doctor taking over. It sounds like a fairly straightforward process, and in many cases it is. However, generally speaking, the lease agreements are structured in such a way where they are overly restrictive for the tenant. And as you can appreciate, generally not very appealing to a prospective buyer who has every intention of taking over your practice as well as your facility and the location itself, and practicing dentistry there for an extended period of time. So we will talk about, essentially how to structure the lease to enhance the saleability or the attractiveness of your practice. Additionally, your lease agreement should provide you with fair and affordable financial terms. I'm sure that this is a pain point for many of you because for most practices, rent tends to be one of your larger overhead expenses. For the average dentist in North America, many of you will likely agree that rent is probably your second or third biggest overhead expense. Generally, primary biggest expense or overhead expense is going to be wages and staff wages. Second and third interchangeably are generally rent or occupancy expenses and lab expenses. So it's natural when we talk about fair and affordable financial terms that it may be, a particular concern for many of you. But it is important, of course, that your lease agreement provide you with fair and affordable financial terms. Now, when I talk about fair and affordable financial terms, I'm not simply talking about rental rates. For many of you on a monthly or quarterly or annualized basis, in addition to your rental expenses, you will generally also pay for your proportionate share of common area maintenance, generally abbreviated as CAM. Many of you will also pay for your proportionate share of property taxes, as well as a contribution towards insurance on the building. Unfortunately for many of you, those fees likely seem quite excessive, and they likely increase year over year, even though the general maintenance and upkeep of your property likely doesn't follow suit. So one way to ensure your lease does provide you with fair and affordable financial terms is if you have a lease agreement coming up for renewal or expiring within the next 1 or 2 years, or you're signing an entirely new lease, we do want to structure the lease to ensure as the tenant that at the end of every year you are provided with very detailed and itemized common area maintenance reconciliation statements. It's essentially a statement from your landlord summarizing the actual expenses they incurred in the maintenance and operation of your building. And we also want to have the ability to audit those statements to ensure the numbers are accurate. That, in addition to obviously negotiating reasonable base rental rates, will ensure that your lease agreement has fair, reasonable, and equitable financial terms. Your lease agreement should also provide you with long-term stability and security. From experience, we've learned from servicing the dental community for 20 going on 25 years now that it is awfully expensive to build a dental office, and it's equally as expensive to relocate the office from one location to another. For that particular reason, it's essential the lease provide you with long-term stability and security. Generally speaking, from experience, many of you will structure your lease agreement where it comes up for renewal or expires every 5 years. And generally speaking, that's because the landlord may have encouraged you to do a 5-year arrangement, or in other cases, it's because many of you are simply uncomfortable extending the lease for anything beyond 5 years. We generally recommend the more long-term the lease, the better. Obviously, case by case, but in most cases, we do recommend a 10-year term with 2 5-year renewal options. So essentially 10 plus 5 plus 5. The reason we recommend that is for a number of reasons. Number one, when you sell your practice, generally speaking, the banks require a minimum of 5 years of term on the lease agreement in order to finance the buyer. So if we have more term on the lease, it will actually facilitate the sale or acquisition of your practice. But secondly, and quite relevant as well, when you're negotiating a lease agreement with any landlord, whether you're negotiating with some of the more sophisticated landlords like the RioCans, the Cadillac Fairviews, the Kimco properties, the Upland properties, the Brixmores, these are some of the multi-billion-dollar real estate investment groups. Generally speaking, they prefer more long-term commitments. And if you're prepared to offer a 7-year term or a 10-year term, something more long-term than 5 years, generally they will be prepared to provide you with more attractive terms, including generally more reasonable and more attractive rental rates. So again, part of the reason we recommend structuring the lease to have a 10-year term with 2 5-year renewal options is not only does it facilitate the eventual sale of your practice, but it also provides you with the necessary leverage to negotiate very reasonable and appealing financial and legal terms with your landlord. Your lease should also minimize risk and exposure. Now, as I mentioned earlier, from experience, most of you likely would have provided your landlord with a personal guarantee. We actually will spend some time in a few minutes actually going through a personal guarantee provision in your lease, and generally how they're structured and how they expose your family and your estate to risk. However, it is important that if your landlord is adamant that you provide a guarantee, as many landlords are, that we structure the guarantee to be limited in nature and either have an expiry date or cap the value of the liability at a maximum dollar value, thus minimizing the risk and the exposure to you as well as your estate. And lastly, the lease agreement should maximize your flexibility. Part of the way your lease will maximize flexibility is where it's structured in a way that you have the ability to sell your practice or transfer your space to someone else without going through hoops and hurdles and a fairly complicated process with your landlord. But additionally, the lease agreement should also protect your estate. And one of the ways that you maximize the flexibility in your lease agreement is by incorporating something called a death and disability clause. It sounds morbid, and I assure you it's not. Essentially what a death and disability clause will stipulate is, God forbid you pass away, or God forbid you are disabled or physically incapacitated and can no longer practice, it provides your estate with the ability to terminate the lease agreement, generally with a minor rental penalty that they will pay the landlord, or alternatively, it will also enable your estate to sell the practice at the appropriate time without going through a fairly complicated process with your landlord. In addition to the death and disability clause, we do recommend that all practitioners have a right of first refusal incorporated into their lease as well. What a right of first refusal will stipulate is that if there is space available for lease in the building, preferably adjacent to your unit, the landlord will be required to offer you that space first before they list it or before they offer it to any other tenant in the building. Essentially, the right of first refusal essentially acts as an expansion option that you're not required to use, but you can exercise the expansion option if need be, and again, assuming the space adjacent to you is available for lease. The other way of structuring a right of first refusal for those of you who are in smaller buildings, particularly freestanding properties or just generally smaller, more affordable properties, is it will also enable you to have the option to purchase the building if it is ever listed for sale. So again, it's a wonderful option to have, and again, if you have the death and disability clause as well as the right of first refusal, it'll maximize your flexibility under the terms of your lease agreement. Now, as we talk about transitioning and selling your practice, just at a high level, there are really three variables that will factor into the valuation of your practice. There is going to be obviously the value of goodwill. This is, what it really boils down to is how much the practice is cash flowing, how much you are grossing on an annualized basis, how much you are netting, and how much you are collecting. And generally, you will have your practice appraised by a group like MNP or another accounting firm. And what they will do is they will determine EBITDA, earnings before interest, tax, depreciation, and amortization, essentially earnings. And depending on the marketplace and the demand, they will come up with a value of what the goodwill, including your equipment and the facility itself, will come out to. But it's important that you all understand the lease agreement as well as the location itself will factor into valuation. When a doctor purchases your practice, they're not simply purchasing the goodwill, and they're not simply purchasing your equipment such as ADEC or Pelton chairs and Sirona and cone beam and so on. What they're essentially purchasing is an established business in an established location that has been generating positive cash flow for many years. But without the location, without the facility itself, the valuation is significantly less. And for that reason, the lease agreement factors into valuation. It's important that all of you are aware the lease agreement can determine as much as 100% of the valuation of the practice. In other words, if the lease is not properly structured, in many cases, it can make your practice virtually unsellable. So we're going to discuss in a minute or so the assignment and subletting section of your lease, which is particularly relevant as it talks about the transferability of your lease from one person to another. Just an interesting fact that, unfortunately, I think most people are likely unaware of. Unfortunately, most dentists do not know that the lease agreement can have very restrictive terms that may actually prevent you from selling your practice. And as I'm sure many of you probably could appreciate, most dentists, unfortunately, do not learn this until it's too late. And they're forced to learn it the hard way when they're going through the motions of trying to sell the practice, are in discussions or in communications with a prospective buyer, and at the last hour are advised that the lease agreement and the terms of the lease are prohibitive and may actually jeopardize the sale of the practice. That is why it's important that we discuss the assignment and subletting section. The assignment and subletting section is the provision in your lease agreement that talks about the transferability of your lease from one person to another. And essentially, this is the provision in your lease agreement that enables you at some point in time to sell your practice and transfer the lease from one person to another. Now, it's important that you understand before we go through this that many lease agreements are, by design, structured to be very restrictive to you as the tenant and protect the landlord's interests as much as possible. And I don't want to imply that landlords, intentionally want to overcomplicate the process when you sell your practice. However, we deal with, I would say, probably a few hundred cases a year where landlords like to impose potentially unreasonable conditions when it comes to getting their consent to a transfer of the lease. In other words, many landlords will actually leverage their control over the transferability of the lease to generally drive rental rates up for that particular unit, or we actually dealt with cases where landlords will even ask the seller for a percentage of proceeds from the sale of their business. So a perfect example, we are working on a case right now in Manhattan, in New York. General Dentist has been in their space for 20, 30 some odd years, practicing general dentistry. They went through the motions of getting their practice appraised, have a potential buyer, and the buyer and this doctor have formalized a conditional agreement to purchase and sale. When the doctor selling the practice approached the landlord to request their consent to an assignment of the lease from them to this new doctor taking over, the landlord advised the selling doctor, they would only consent to a transfer of the lease if the selling doctor agreed to either one of two scenarios, the first being that they agreed to pay 25% more in rent, keeping in mind their rent currently is about a little over $9,000 per month, so you can imagine what that increase would entail and how that will impact the valuation of the practice. The alternative option the landlord presented the seller was no increase in rent, but they were expecting the seller to pay them 10% of the proceeds from the sale of the business, and this is a practice that was appraised at $1.2 million. So not to suggest that we deal with those cases, regularly, but I will say on a regular, probably daily basis, we encounter cases where very similar situations but less extreme, where you are requesting approval from the landlord to transfer or assign your lease agreement, and the landlord is asking for additional rental payments per month or a percentage of proceeds from the sale of your business. And for that reason, it's essential the assignment clause is properly structured. So as we go through it together, what you'll notice is, fairly regularly and commonly, you do need to get the landlord's consent to a transfer of your lease. For some of you, it will be stipulated that their consent will not be unreasonably withheld. However, unfortunately, many of your lease agreements will not define or dimension what would be considered reasonable or unreasonable grounds for the landlord to withhold consent to a transfer of your lease. Additionally, it will stipulate that within 15 days after the receipt of the landlord of an application to transfer your lease, the landlord will have the option to terminate your lease or to revise your rental rates and charge a premium on the rental rates. So, going back to the case that we're, in the process of working on in Manhattan, many of you, unfortunately, the way your assignment clause will be structured are really in a position where you're exposed to your landlord's will in terms of whether or not they will be reasonable at the time of retirement and transition. Additionally, I would say for almost all of you, it will be stipulated that even after you've gone through the motions of selling your business and getting a formal approval from your landlord to an assignment of your lease, it will be stipulated that you, the selling doctor or the assignee, will remain jointly and severally liable with the new doctor who has taken over. In other words, you will remain a guarantor for the new doctor who has taken over your business. Unfortunately, we represent about 1,000 doctors a year across the country, and we review and analyze probably a little over 2,500 leases for doctors. And I would say 75%, if not more, of all leases we review have it stipulated in such a way where the assignment clause is structured the way that you see before you, and the landlord can impose unreasonable conditions as it relates to the sale of your business. So important that we understand that we need the lease agreement to be structured properly and preferably have very limited landlord involvement at the appropriate time when you sell your practice. Now we're going to take a minute or two to talk about a personal guarantee in your clause, as many of you have unfortunately provided personal guarantees. Now, something that you should know is there are different levels of guarantees. Unfortunately, most commercial tenants, not simply dentists, have agreed to provide their landlords with unconditional personal guarantees. And there are unconditional personal guarantees and there are limited guarantees. Unconditional personal guarantees generally never expire, and there's no cap on the dollar value of that particular liability or guarantee. That is the difference between unconditional and a limited guarantee. Unfortunately, for most of you, you likely would have provided unconditional personal guarantees in your lease, and likely because the landlord had advised you that no tenant moves into the building without providing an unconditional guarantee. Just so you know, that is completely untrue, and every single part of the lease agreement, including personal guarantees, are negotiable. And generally what we do, our goal when we are retained and representing our clients during a renewal, is to remove or limit the personal guarantee. So you'll see before you that it stipulates that the tenant hereby agrees to provide an unconditional guarantee and be bound by the terms of the lease personally with the landlord. It's further stipulated that the guarantee will survive for the initial term, including any renewal options, and that the landlord is going to expect you to execute a personal guarantee generally attached as an exhibit, schedule, or rider to the lease agreement itself. So anyhow, important to note that personal guarantees are absolutely negotiable, and generally what we want to do is negotiate either to have the guarantee stricken from the lease, or at the very least structure the lease where the guarantee itself is limited in nature, and either there's an explicit expiry date or the value of the guarantee is capped at a maximum dollar value. But it's essential that you understand the timing of the negotiations is everything. So I know for many of you, you currently rent your space and likely have a lease agreement either expiring or coming up for renewal sometime within the next 1 to 2 years. Arguably, one of the more important things we will discuss this morning is when to start negotiations. And one thing that we cannot emphasize enough, the earlier you start negotiations, the better. We generally recommend that you start the negotiations preferably 2 years or 24 months prior to the expiry date of your lease. Many dentists will start the negotiations within 6 months of the expiry date. And not to say you cannot negotiate with 6 months of remaining term, but you've diminished your leverage significantly, and in large part because most landlords understand to relocate a dental office, aside from the fact that it will cost you between $250,000 to $500,000 to install leasehold improvements and build a new office, it generally is a year-long, if not more than a year-long process. And when you start negotiations with 6 months or 8 months left, the landlord will naturally operate under the assumption that you have every intention of renewing your lease agreement because, frankly, you do not have sufficient time to relocate from one location to another. The earlier you start negotiations, the better, and again, we recommend that you start the process ideally 2 years before your lease expires. Now, in terms of actually how to negotiate the lease agreement, this is the 7 to 8 step process that we follow in every case that we take on. We always start by getting a copy of your lease agreement. We will identify what are your goals and your career objectives. If you're thinking of transitioning and selling your practice in the next few years, our focus and recommendations for the negotiations will be to structure the lease to be aligned with your transition or retirement plans. If your plan is to practice dentistry for another 15 to 20 plus years, our goal and our strategy will be tailored based on what you're looking to accomplish. Third step, we will review all of the lease documents, including all supporting documents, so the original lease, all amendments, addendums, riders, exhibits, essentially every document to ensure that we are properly advising and counseling you. The fourth step of the process is our leasing team internally will do research on rental rates and comparables in terms of what you are paying in rent by comparison to what you should be paying in rent. Then we will generally get on a quick strategy call with you, the client, to talk about life, go over our findings with you, and talk about the strategy for the actual negotiations. Now, what you'll notice is we have gone through steps 1 through 5 of the process. However, we have not yet contacted the landlord. When we do eventually contact the landlord, we always start the conversations off by negotiating the financial terms. It's a very friendly and cordial process, but landlords generally prefer to talk about money as opposed to talk about legal terminology. So we start the conversation off with what they want to talk about: rental rates, maintenance fees. It's generally, for those of you who have lease agreements coming up for renewal, generally we are able to convince the landlord to provide you with a tenant improvement allowance to paint your walls or renovate your floors or just modernize the office. Anyhow, all of the financial and economic parts of the conversation are discussed during the initial stages of the negotiation. Generally, step 6 of the process takes about a month. It's usually about 4 to 6 weeks of back and forth negotiations before everyone is agreeable to the financial terms. Once everyone, you and the landlord, have agreed to financial terms, we then move on to legal. This is where we will negotiate personal guarantees. death and disability clauses, right of first refusals, assignment sections, non-compete or exclusivities to your particular specialty. There's a long list of legal terms and amendments that need to be negotiated. This part of the process is incredibly complicated and very time-consuming. It's usually between 4 to 12 weeks of back-and-forth negotiations before all parties are agreeable to sign the lease agreement. From experience, most projects are usually a 2 to 4 month negotiation from beginning to end and generally require 30, 40, 50 plus hours of legal and administrative time. So it's important that you start the process early and over-prepare for the negotiations. Now, just at a high level, as I mentioned earlier, we work with all doctors, whether you're starting a practice, renewing your lease, expanding or relocating, or starting to prime your practice for sale. And regardless of what phase of your career you are in, it's essential the lease agreement is properly negotiated. Now, just to summarize some of the key takeaways, we want to ensure the lease agreement is properly structured to support a very seamless, stress-free, and profitable sale of your practice. We want to be strategic with how we approach the negotiations. We want to make sure we over-prepare and identify every item that needs to be negotiated. When we actually start the negotiations, start as early as possible, preferably 2 years out, and it's essential that you are as friendly as possible throughout the negotiations. The friendlier you are, the more receptive and responsive your landlord will be. And thirdly, and lastly, as I mentioned earlier, try to start the process as early as possible. It's arguably one of the more important things we will discuss this morning. Start the process preferably 2 years out. Now, just very briefly, and Andrea is going to take over in a minute, one of the services we provide is called a critical dates and risk analysis. Essentially, it's a review of your lease agreement. Generally, what we will do during the lease review is you will email or fax us a copy of your lease agreement. We will spend on average 3 to 4 hours reviewing your lease, including all supporting documents. Our leasing team will do research on rental rates and comparables to get an idea of how much you're currently paying in rent by comparison to what you should be paying in rent. And we then set up a 1-hour call with you to go over all of our findings, in layman's terms, explain to you what needs to be revised or amended in your lease and how to do it. And we essentially help you devise a strategy for the negotiations with your landlord. As our way of saying thank you for joining us this morning, it's normally a $1,500 service. However, for any of you interested in getting your lease reviewed, we are actually going to be waiving the $1,500 fee, and the lease review will be offered to all of you completely free of charge. So if you want to just very quickly jot down my contact details, and we will put this on again at the very end of the webinar, but if you are interested in the complimentary lease review, I do ask you kindly to please email me within 24 hours, just simply letting us know that you are interested in the lease review, and we will then coordinate to make arrangements with you to get a copy of your lease and schedule the phone call. The only condition is that if you are interested in the lease review, the offer for the lease review will expire within 2 weeks. So we put a 2-week expiry date because we want you to be proactive. We want you to take advantage of the offer sooner than later. Again, it's completely complimentary, but we understand how time-sensitive many of these projects are. So if you are interested in the lease review, please feel free to just shoot me an email or you can give me a call. Simply let me know that you are interested. And again, the call needs to be scheduled sometime over the next 2 weeks. Anyhow, I do want to thank you all very much. Andrea, I'm going to let you take over. And again, if there's any questions, we will put both mine and Andrea's contact details on a slide at the end of the webinar so you can get in touch with both Andrea and myself.
That's great. Thanks, Justin. Hi, everyone. So a little bit about our firm. At MNP, we have a niche team of accountants and business advisors across Canada, and we specialize in helping dentists to prepare their taxes, save taxes, buy and sell their practice, and really consult with them on financial matters throughout the year. We have helped thousands of dentists throughout Canada save taxes and meet their financial goals. Really, the purpose of today's presentation is to help you have a general understanding of what you need to do to prepare for a sale. I'm based in Toronto, so I've used Ontario tax rates and Ontario PC rules. My partners across the country will tailor their tax planning and structures based on the province you're in. There's going to be quite a bit of information, but don't worry, we're not expecting you to do this by yourself. All successful dentists have a strong team that helps them get through the process. So we'll be going over the general selling process, what you need to do to plan for the sale, and give you some ideas in terms of how a sale can be structured to minimize taxes. The sale process is quite involved, and usually most sellers only do it once in their career. It's really important to form a good team to help you have a successful sale. A good dental accountant, broker, lease consultant, and lawyer will help you transition your practice, maximize the value, minimize taxes, and ultimately reduce your risk. We would expect the buyer to have his or her own corresponding team. Buyers or sellers that don't have a team specialized in dental will be heavily disadvantaged. We'll go through some of our experiences as we walk through the rest of the slides. What we find is that when either the buyer or seller doesn't have a team that understands a dental transaction, the overall cost ends up at least double what it should be. Without a specialized team, the seller could also end up paying significantly more taxes from lack of planning. And that's both throughout, their career and then ultimately on the sale. Now, when a dentist is discussing the possibility of selling their practice with their accountant, we would want to have an idea of what their practice is actually worth to figure out when they retire, when they can retire, and what type of tax planning is available. One way to get the value of your practice is to contact a broker to put together a valuation report. This valuation will help potential buyers get financing at the bank as well. I've listed out some of the information on the slide that you would need to gather for the purposes of evaluation, but in the interest of time, I'm going to highlight some of the information for discussion. So the first point, the last 3 years of financial statements. By gathering this information, it provides a pretty good snapshot of how profitable your practice is. It is a good idea to meet with your accountant to discuss how you can increase profitability by either increasing billings, decreasing your expenses, or minimizing taxes. You do this once a year at the very least. By going through this exercise, you'll increase the amount of money in your pocket even before the actual sale. And by increasing profitability, your practice value will also increase. This is also a good time to ensure that you have a good accounting system in place so that you can understand how your practice is doing day to day so you can make decisions. It will also facilitate the selling process by allowing the buyer to do due diligence fairly easily. We've seen clients either have to delay their sale or were unable to sell their practice due to poor accounting systems. Some dentists don't actually have a bookkeeping system in place at all and send the accountant their information once a year to do the bookkeeping and then prepare the tax return. It's really poor planning annually because you never really have an idea of how your business is doing, and by the time you see what's happening, you're already months behind. We've also seen examples of dentists that run multiple practices through one corporation, one bank account, or one program to save money. But when it comes time to sell, it's impossible for a buyer to do due diligence, so the sale falls through. Ultimately, you also have no idea how each practice is doing, so you can't make proper decisions. Reviewing your patient base. It's a good idea to look at your demographics, number of patients, your breakdown of billings, because this will ultimately help you with determining the valuation of your most important asset, which is the goodwill. If you have a good handle on these metrics, you'll also be able to drive your revenues up every year and make more money. You also want to review your referrals out of your practice. It can generate an opportunity for buyers, which increases value if they can do the work themselves. Also, if you know how much work you're referring out, you can think about whether it makes sense to hire a specialist to come in and work in your practice instead. With regards to staff experience and wage levels, that's going to be the last point we're going to cover on this slide. You would want to know whether you're paying market rates and whether they have contracts in place. By having appropriate contracts, it can save you money before a sale by limiting your own severance risk. And for buyers, it protects them from high severance risk when they take over the practice, since the calculation is done from the time the employee was originally hired by the seller. So once you're in the process of actually selling the process, here's a list of things you need to think about doing. Again, I'll pick on a few of these. So transferring your premise lease. Justin covered this extensively, and obviously Cirrus can help you with this ahead of time. I just want to point out that problems with transferring your lease can cause a sale to either be delayed or prevented altogether. We see this all the time. So get this done properly as part of your planning phase. It will save you time and money later on. There will be a due diligence period for the buyer where they'll review your financial statements, the production reports, tax returns, etc., and basically match it to the valuation. So make sure you spend the time and money to get this done right. An issue on due diligence could either prevent or delay a sale or result in a price difference or a price decrease. And if it is a share sale, we'll go over what that means a little bit later on, and there is debt in the company, you have to pay the debt out first before transferring the shares of your professional corporation to the buyer. So if you're selling for a practice for $1 million as an example, and you still have a $400,000 practice loan inside your professional corp, you only pocket $600,000 before paying your brokers, your advisors, and taxes. So make sure you budget accordingly. Your accountant can help you through that. If it is an asset sale, your accountant should be giving you a price allocation because it will affect the amount of tax you have to pay. Keep in mind that there's HST on certain assets as well. And if you plan on working at the practice after the sale, part of your negotiation will be your associate agreement. And as a note, usually the seller's associate rate is higher than the regular 40%. Now, once you have a buyer, a lawyer will draft a purchase and sale agreement to outline what you agreed to. This includes the key items as discussed in the previous slides, as well as the deposit required, your closing date, etc. Normally, we, the accountants, will review the agreement as well to ensure that the structure and any discussions we've had together have been included in the agreement. Normally, the agreements go back and forth from the buyer to seller a few times before it is finally finalized. This is where a specialized accountant and lawyer can add a lot of value in terms of protecting your interests as well as moving the process along. Now, we typically say that it is best to plan at least 5 years in advance of your sale, at a minimum 3 years before your sale. It'll give you time to figure out whether you can retire, figure out ways to improve your practice, do tax planning, and then ultimately design a plan to achieve your goals. And in terms of timeline, these are the stages that a typical dentist would go through, and it gives you an idea of the amount of time it would take to get there. Now, we at MNP help dentists throughout their life cycle. But this slide really is intended to give you an idea of when would be a good time to start planning for a sale. In today's market, especially in the urban areas, we're heavily geared towards sellers being in the driver's seat. The key, though, is to ensure that you have a profitable practice that you can easily transition to a buyer. This requires a bit of work, and having the appropriate team will make the process that much easier. You don't want to squander the opportunity because you didn't have the right team in place to guide you through the process. Now, when buyers are looking for practices to buy, they essentially want a practice that they can literally walk in and take over. Some examples of how you can do that include having a good team of staff that will help a new buyer transition into the practice and keep the patients. Good accounting and patient billing software will also help the buyer review data on a timely basis and make appropriate decisions. Again, these things help you on a sale, but it will also help you run your practice better before the sale actually takes place. So one of the main reasons you'd want to plan in advance is because of taxes. Taxes on a sale is largely driven by how a sale is structured. And taxes can definitely be saved annually even when you're not selling, but we're not going to cover that today. There are generally two basic ways to structure a sale, which is a share sale or an asset sale. A share sale means that you would need a professional corporation to sell its shares to a buyer, which includes everything inside the company. An asset sale, on the other hand, is literally selling specific assets, which includes your equipment, leaseholds, furniture, supplies, computer software, and goodwill. And these assets are generally listed out in an appraisal. Now, normally sellers want to sell shares because of the capital gains exemption. Essentially, $835,000 of the gain can be sheltered per shareholder. In Ontario, there's a $224,000 savings per shareholder. So depending on your province, you can essentially multiply the capital gains exemptions using multiple shareholders. And this is where planning is important because the type of shares they own matters. So note that there's something called alternative minimum tax on the sale, which is basically a special type of tax that you have to pay when you're reporting high income, but without triggering any income tax. And note that the alternative minimum tax is refundable over the next 7 years if you earn income. So that can affect your tax planning after the sale. Again, this is for the purposes of your planning or your budgeting when you do sell. Purchasers generally want the opposite and would rather do an asset sale. This is because there's no hidden liabilities in an asset sale, and the buyer gets a better tax write-off from the asset allocation. So in a share sale, the buyer would take over the asset tax base that you're currently reporting on your corporate tax return. So for very old practices, most of the assets would have been written off already. If it was an asset sale, the buyer would be able to allocate the purchase price over the asset categories and write off more in amortization every year, which means a reduction in their tax bill. So you can calculate how much a buyer would gain in having an asset sale through a tax shield calculation. Now let's take a look at it as an example to highlight the amount of taxes a seller could save if a share sale can be structured. So in this example, we have a dentist in Ontario who's selling his practice for $1 million. If it was a share sale, the first $800,000 or so, I'm rounding, of gain is tax-free because of the capital gains exemption. And the difference of $200,000 is taxed at the capital gains rate. So the total tax paid in this share sale is about $54,000. We're only using one shareholder. If he was unable to take advantage of the capital gains exemption and had to do an asset sale, he would pay about $335,000 of tax. You'll notice that we've separated out the two pieces of an asset sale, recapture and the profit. So when you do an asset sale, it's important to understand that the proceeds are allocated to assets that have been amortized already will be fully taxed, and the remaining profit is taxed at 50% or the capital gains rate. So if you look at the comparison by structuring the sale as a share transaction, that particular dentist would save $281,000 in tax. So the question is, why doesn't everyone structure the sale as a share transaction? And that's because you have to meet certain rules to get the capital gains exemption. We'll go over those rules in a second. These rules are largely related to passive or inactive assets held inside a corporation. Dentists who have a profitable practice and is able to save will usually build up extra money inside their PC. This extra money, whether it's sitting in cash or invested in assets that are not part of the dental practice, prevents the use of the capital gains exemption. And that's why we say that you should speak to your accountant at least 3 years prior to selling, because some of these rules have to be met 2 years prior to the sale in order to get the capital gains exemption. You want to give yourself a year to structure and plan it out. For example, if you're a saver, 50% of the assets have to be active 2 years before a sale. If you've purchased tax shelters in the past, as another example, you'll need to deal with the cumulative net investment loss balances and clear them out. And that requires time. If you want to add additional shareholders or use their capital gains exemption, they have to be a shareholder for at least 2 years. The only exception to that rule are dentists who have been practicing for 2 years unincorporated and then decide to transfer it into a PC before a sale. In that case, he or she can use their own capital gain exemption, but again, not anyone else's. And with practice sales increasing in value, dentists often require other shareholders to help them minimize their taxes. And these rules are complicated, and the tax planning you would have to do to be on side can get quite complicated as well. So really the point is that you need to do planning 3 years in advance to give yourself time to meet some of these rules. So let's go over a real-life example. We have an Ontario dentist who wanted to retire early, and he was referred to us right before the sale. And he asked us to help him with the sale. His current accountant, unfortunately, didn't update the tax planning when professional corporations were allowed or when they changed the rules to allow family members as shareholders. So his practice was split between an old hygiene company owned by his spouse, and the rest of his practice was unincorporated. So we reviewed the valuation prepared, and at the time it was worth $950,000. The value had to be split again between the unincorporated practice and the hygiene company. So at that time, he made about $550,000 a year net and needed all of his income for annual living. He invested in a bunch of tax shelters that resulted in a cumulative investment loss of $750,000. So basically, if he sold right away, he would have to pay $174,000 in tax. Now, we were really fortunate because even though he wanted to retire, he didn't have to retire right now. He was healthy and was willing to practice for 2 more years. So we had time to reorganize the structure to combine both the unincorporated practice and the hygiene practice into a professional corporation. Ultimately, our goal was to access both him and his wife's capital gains exemptions and income split with his daughter for the next couple of years. Note that, if he incorporated before, he could have saved taxes every year by paying dividends to his daughter. But we didn't highlight that in this example. So over the next 2 years, what we did was basically pay out all of the dividends to himself, his wife, and his daughter so that he can meet his living needs. And by doing that, we were able to save taxes annually, and therefore he even had more money in his pocket before the sale. We were also able to get rid of the cumulative net investment loss issue and move value from himself over to his wife so that we could use her capital gains exemption. So all those numbers basically detail what we did. During the 2 years that we worked together, we were also able to point out some areas where he could be more efficient and therefore increase profitability. And at the end of the 2-year wait, his practice was appraised for $100,000 more. So just over $1 million in value. Because of the planning that we did, the entire gain was able to be sheltered via him and his wife's capital gains exemptions. So he paid 0 tax. Basically, he saved $174,000 in tax by structuring the sale properly. So it's really key to do some of this planning beforehand. So the previous scenario sounds amazing. So when would a seller do an asset sale instead? It's either they have too many passive assets and didn't plan ahead, or they've used the capital gains exemption already from selling their other practices, or the gain is so large that it can't be completely sheltered through the capital gains exemption anyway. So remember that if you are in this situation, there is some planning you can still do to minimize the gain or the taxes. The key is figuring out how to allocate the assets. We've been in situations where the offers are so competitive or there's so many buyers that when the deal is an asset sale, we negotiated for a price increase because the asset allocation would give the buyer a tax benefit. So remember, we talked about a tax shield earlier. So keep in mind that regardless of your situation, even if you didn't plan ahead, it's never too late to speak to an accountant and see what your options are and what can be done. Now, we talked about a share sale and an asset sale. There's also something a little more creative, which is a mix of the two. We call it a hybrid sale. Now, this isn't for everyone and is more restrictive now that the budget changed the taxation of goodwill. However, in situations where a dentist is selling the practice for a substantial amount of money, it could be worthwhile considering if you can benefit from both sheltering the gain through a share sale and an increase in cost base for the buyer in an asset sale, and therefore, getting more money in your pocket for both of you. Now keep in mind that since a hybrid sale includes a share sale, you would need to make sure you meet those qualified small business corporation rules to have this as an option. So this, along with the share sale, may not be an option for someone who hasn't planned ahead. So in summary, speak to a specialized accountant so you can plan for a sale ahead of time. It will make a substantial difference in how much money you can keep in your pocket. Even though, generally speaking, a share sale is advantageous, a share sale may not be the best option. So go through the analysis and find the right option for you. With the changes in the tax budget, last-minute transactions have even less options for tax savings. unfortunately, the number of times that we've seen practices not being structured properly for a sale and dentists being in a position where they have to pay way more taxes than necessary is really unfortunate. We're available for a second opinion. We have a team of dental accountants across the country, like we mentioned, who are happy to review your situation. So feel free to contact me, and I can connect you to the right person in your province. On the last slide, I have my contact information. So again, feel free to contact me. Over to you, Justin.
Andrea, I want to thank you all, and doctors, do want to thank you all very much for your time this morning. I know that we covered off quite a bit in a very short period of time, and I'm sure many of you do have questions. Again, please feel free to reach out to Andrea or myself. Both of our details are there. Andrea and their team are wonderful. They are more than happy to support you and have conversations with you, and at the very least provide some advice and some direction. And for all of you who lease your space, I would encourage you to get your lease reviewed. It's a complimentary service. It's beneficial. You'll understand whether or not you're overpaying in rent, but additionally, if there's any liabilities currently in your lease. So again, if you are interested in the lease review, please feel free to call or email me. And again, both mine and Andrea's details are there if any of you have questions or just want to connect or just have a conversation about your practice. Anyhow, I do want to thank you all again for your time. Andrea, I wanted to thank you all very much.
Thank you.
And doctors, be well, take good care, and thanks again for your time. Take care.